Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlan, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. Welcome back to the show, Bob.
Yeah, hi, Jim. And it's been one fantastic week in the financial markets. It's been amazing.
Well, when you say fantastic, I'm sure people aren't happy to see record drops in the Dow for one day and an entire week of what we call a red board. We were used to seeing over the last year, I would think, where you'd have very positive markets Monday through Thursday, then Friday there would be a minor correction. Well, this is a whole week of those Fridays. Bob,
yeah.
What's your analysis here?
Well, we're actually looking pretty good on this because in early October, we'd looked at the market setup and figured, hey, this is going to go for a strong rally out to around January, which then we've used it actually back in 2017. Same thing, early October and a rally out till the end of the year, and that was then the high on the Bitcoin phenomenon, and then the big markets were hit by a 20% sell-off. But you've had in the past very important market events conclude in the January window. You had the Nikkei at the end of 1989. You had the huge gold and silver speculation that blew out in January 1980. Any number of them. 1973, that was another big bull market for New York, followed by the worst bear market since the 1930s. So we're very aware of these things, and so indeed the stock market took off and had reached measurable excesses before, well, actually in the January window, with the New York Stock Exchange Composite setting its high then, and then you had like the S&P and the Dow, which are institutional favorites around the world. They bid those up just into early February, but hey, it's enough when you got the broad market setting its high in January, so that worked. And then you had also you can never know the reason for the rush in a market, but you can measure the degree of the rush, which we did. So you ended up at exceptionally high valuations, high momentum, high sentiment, plus some sequential sells. So that was occurring as the market was topping. And then what has happened, of course, is that the virus scare. Now, there's two aspects to this. One is the direct threat to the average person's health, and it's probably the person who has precarious health that has a serious threat with this thing, but people with ordinary health not. But the other thing is that governments have used it as an excuse to move in with control. And the more authoritarian the government, the stronger the controls, which has been the case. Of course, China is the example. So you've got a potential pandemic, but you have an actual panic in policymaking circles, but mainly to control people. So I think this is a great blunder, the big hoo-ha about it, and at some point people will look at it rationally. Now, the last such scare was with the SARS threat, SARS, and that was began to appear in November 2002, and by June, July, I looked it up yesterday, of 2003, the scare and the panic was quite eased by that time. But you also was the opposite end of a financial market. That was when the bear market was concluding, late 2002, and then the final washout in March of 2003. And this one is associated with the top of a market, and thereby the market was very vulnerable. And this is, and remember, we were calling it the everything bubble. We were looking for the everything correction, which would lead to an everything major setback. And wham, it all happened very quickly. And so you've had serious hits in base metals, and a very serious hard hit in crude oil. And so this could be a cyclical change. So what we want to do, Jim, is look at the market overbought at the right time, and that included the action in industrial commodities, and boom, it reversed, and then was made worse by an international panic about this disease threat. Now maybe, and some of our technical stuff is suggesting that perhaps this major hit, which has been very fast, has reached excesses on the downside. And any people wanting to go long in this kind of a market, you'd have to be a very skilled trader to catch some of the bounces. But before one even wants to consider re-entering the market would be a bounce and then testing of the panic lows, and this is ahead of us. So, and I wouldn't advise anybody other than the most sharpest of trading desks to try and trade this thing. So, it's happened very fast, and what one wants to say is, what does it mean? And it means to us, it looks like, a cyclical change. You have now got credit spreads, which is the difference between high-grade and low-grade bonds, are again back to widening, which is a negative. And you've had the yield curve, which is the difference between interest rates from long end to short end, and in a boom, because of speculative demand for short-term funds, it can raise the short rates above the long rates, and that then is called inverted. And we've got the yield curve in the U.S. going back to, I think it's 1857. And the rule is that if the curve inverts, there will be a recession in the U.S. Now, there's some nuances in here that we've looked at in 2007, which was the last cyclical peak in the stock market. The yield curve inverted twice as that market was topping and rolling over. And then also looking at the yield curve in 1929, that was the case as well. It had two thrusts to inversion, and then as the market was topping and then rolling over. And then the bubble before that, the great bubble of 1873, well, damn me if the yield curve didn't do the same thing, inverted twice as the bubble was concluding. So here, and then now, you had the inversion that was talked about a lot in the summer, and then more recently the curve is inverted. This will be changing now because the T-bill rate has come down very fast in the last couple of days. So, Jim, there's lots of warnings out there on the overall financial mania and bull market.
Well, Bob, I remember you saying, I think back in July, when the yield curve first inverted, you said, well, typically 7 to 9 months from now, we'll see the market have a major correction. And it doesn't matter if the yield curve even goes back to normal, it still is predicted that, and that's likely going to happen. Well, are we not in that prediction?
Yeah, I think you got that one. Yeah, Jim. The other part that was interesting is people were concerned when the curve inverted in the summer, and they were rightly so. And then, of course, it backed off from inversion, in which case those that don't follow it closely then said, oh, it's not inverted anymore, but they don't realize that it's the specific event of inversion is a market phenomenon in the credit side of the equation. And once it happens, and as I say, you got data all the way, my charts go all the way back to 1857, and it says every time it inverts, you have a recession. So it's a function that in a big bull market, the stock market gets most of the press, the attention, the media, but within this, you've got the credit markets, and they are become dominated by speculators, and the reason I think that short rates go up faster than long rates is that in a financial party, investors are confident in buying the long end of the market, which it's a downward pressure on those rates. And then within the curve, at the front end of the curve, you've got the demand for speculative funds as people leverage up margin accounts and all that sort of thing. So then that briefly pushes up the short rate. So you then have short rates higher than long rates. And that is due to speculative urges. And it's like clockwork. I mean, it's tough, Jim, when you're in it, but when you're looking back over your shoulder, it is kind of like clockwork. And here we are. A very dramatic sell-off in stock markets, in industrial commodities, except lumber. It's been doing well, but then we've seen the housing market in the U.S. is still pretty good. So, and you get a mighty whack, which has been made worse by a panic in government levels about a health threat. So the bulls in this kind of a market, it's just hopeless. It's impressive how fast this thing has come down. But then according to our technical work, there could be a bounce out of this level, and some of the things are starting. I think the difference between the credit spreads, if you look at the J&K and TLT, got whacked in the morning, and they're starting to recover a little. So, and then you had the counter trade, which was the gold and silver, became the favorites going the other way, and then boom, all of a sudden they get hit. So let's just say it's fast markets, and only the best of trading desks can take advantage of some of these swings. But I think our point of view through Christmas and into January was appropriate, that stock market was very overvalued, that momentum excesses had been clocked, technical excesses, and we're get a sequential sell. So it was set up to come down and then made worse.
We'll have more with Bob Hoye right after this.
Do we want to do the headlines?
Oh, yeah.
Cypress Development Corp. is developing a world-class lithium resource in the heart of Clayton Valley, Nevada. The size of the resource makes the Clayton Valley project a premier asset with the potential to impact the future of lithium supply. Cypress Development Corp. trades on the TSX Venture Exchange, symbol CYP, the OTCQB, symbol CYDVF, and on Frankfurt, symbol C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Welcome back. We're speaking with Bob Hoye. Bob, U.S. home sales have surged to their highest level since 2007, and their prices are up 3.8%. Why is the American housing market booming right now?
Well, it's terrific. I think it's part of the Trump reform, where he's lowered corporate tax rates and he's made it a friendlier country to do business. Many corporate funds were parked elsewhere. They've been coming back. So there's a confidence. And so while the rest of the world has been weakening, the U.S. has remained firm. So as I say, but then when you see a headline about being the best since 2007, that sure gets my attention. And so that's one of the ironies, that you've got very positive stuff underlying there. And as I said, where base metals and crude oil have been weak, lumber was continuing firm until just this week when it's been hit a little. But there's nothing technical excess on the way up on that one. So it's one of the ironies is that the U.S. is still showing some good economic numbers. And then at the same time, when Mr. Market and Mr. Margin come along and pull the pin on all the hot games, it's one of the ironies.
Now, does drop in the Dow and the stock market in general trigger a recession, or can it just be an isolated thing where it's just overvalued stocks being corrected to reality, and should that not affect the economy because of that?
Oh, good one, yeah. They usually, in most of market history, you have a bull market for stocks, and it'll peak out, somewhere like 10 to 12 months before the economy does. But when you're in a world of financial bubbles, as we've been in, the financial side is so big relative to the whole market that when it turns down, when the stock market turns down, the financial side turns down, then the business activity turns pretty quickly with it. And, for example, in 1929, the stock market peaked in September, and the economy peaked in that August. So there was just that's within the range of error in doing statistics. So effectively, the peak in the economy and the stock market were together. And the same thing with the bubble of 1873 in New York. The market peaked in that September, and the economy peaked in that October, and was followed by a long recession. Now, what we want to do is move to the Federal Reserve, and the original promoters in the early 1900s of the Federal Reserve System, of course, they all understood that if you had, and this gets direct to your question, Jim, they all understood that a financial setback or crisis preceded a recession. So then the theory behind the Federal Reserve was that, being a lender of last resort, they would come in and salvage a company that was in financial distress, and then they would then prevent the financial setbacks that preceded recessions. Hey, it's a beautiful theory. But there's been 18 recessions since the Fed opened its doors for business in January 1914. So the physicist side of me says, hey, the theory doesn't work, and yet they keep applying it. And here we are. you have now quite a financial setback. And this, just from the rule of thumb, would suggest that a recession will follow, inevitably. But then, even before the financial setback, just the yield curve inverting twice mathematically suggested that there would be a recession at some point. And then now with the Chinese Communist government in a full-blown panic, have shut down cities, and that has really hit airline traffic, all kinds of things, and it will have little influence on the spread of this disease threat. So my observation, I wrote a little paper on that, Jim, that this panic by an authoritarian government will eventually be seen to be useless, and it could then diminish the esteem for central control governments, and this would be part of a popular uprising in China, where you've got the freedom and the prosperity in the southern provinces, and you still have the authoritarians in Beijing. And with this tremendous slowdown in China, their tax revenues will diminish, but the communists will, of course, demand to live well. So this is setting up a possibility of a serious popular uprising in China in the southern provinces. You've already got uprisings in Hong Kong. So the irony is, Jim, that at the end of this, those who are paying for the intrusion of communists in Beijing are going to say no. In which case, in business terms, Hong Kong will have done a reverse takeover of Beijing. I think the Hong Kong could become the government of China, and Beijing and the communists could just become a sort of a rump, like the leftovers of the Western Roman Empire when all of the apparatus of government went to Constantinople where the money was. So the big picture thing is intriguing to speculate about, and we'll just see if indeed at some time Hong Kong does take over Beijing. It'll certainly be taking over the southern provinces, because the southern provinces, with whatever prosperity is left, are not going to want to submit it to the greedy authoritarians in Beijing. So, Jim, and there's an old Chinese saying, may you live in interesting times.
We'll have more with Bob Hoye right after this.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon, trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Bob Hoye. Bob, Germany's really taking it on the chin with falling exports, and that's what drives their economy, Volkswagen being their biggest company. And car exports run their country. What's their prospectus right now?
Oh, that has got to be pretty bleak. This was the fourth quarter with the falling exports, and part of the headline was that it brings the German economy to a standstill. And that was in the fourth quarter, when a lot has changed in the last few weeks. So this suggests that the slowdown in Europe is real, and it'll more than likely get worse with this hit to the markets. And then, of course, the German government has ruined their economy anyways with the craze for renewable electricity from windmills and solar cells, and they wax their nuclear power, electrical power generation, mainly because of fear. And so Germany has been most aggressive in doing the authoritarian power generation from windmills and solar cells, which increases the cost of electricity hugely. Now, whether the German economy gets billed for it directly or indirectly with subsidies and disguises, it's still the same thing. Their electrical costs have soared. And then the other thing that's crazy with going to solar cells and wind turbines is that it's intermittent power. So you have to have a backup with a coal plant or a nuclear plant or a natural gas plant. So it costs double to have this renewable energy thing. And the proponents of it never stop to think of the costs because they're caught up in a passion that it really is the fear industry, and the fear is of carbon dioxide, for gosh sake, which is a trace gas, and it's essential to all forms of life. And so they're using this as an excuse to ruin the economy. And I often, Jim, wonder, with this turn to central control of everything, it always ends up in destruction. Like, in a good example is the 20-year collapse of Venezuela from prosperity to desperation. So why do they do it when you know that the result of every major centralizing intrusion is disaster? And it just comes down to control. That these people have to control you, and then when the controls come in, the economy heads south and the collapse begins. So Germany is the example, and we'll see how that goes. It'd be sad to watch such a formerly prosperous economy being ruined by authoritarians. But I think I've gone on too much about authoritarians.
Yes, time to stop the show, Bob.
Hey, Fish, we will wish you well for next week.
My guest has been market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. If you have any questions for Bob, we'll be happy to answer them. You can send them to info@howestreet.com. Our YouTube channel is Talk Digital Network. Find us on Twitter at Howe Street. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of Howe Street Media Incorporated.